Welcome to your Mortgage Insider Update for March the 3rd. We come off the Personal Consumption Expenditure, PCE, the Fed's favored measure of inflation report came out on Friday, holding pretty steady, going from 2.6 to 2.5%, with the projections going forward of pretty much around 2.5% inflation. What I mean by that is the likelihood of substantially lower inflation as the Fed's target level of 2% is quite a ways off. So we're likely to see a pretty steady hand from the Federal Reserve in the short-term interest rate department. Now, we've seen short-term interest rates be impacted or lowered at the end of last year, and long-term interest rates actually did the opposite and went up. So we're going to take a look at the charts on a little bit wider scale for the last year and kind of see where we land and what's likely to be some pretty steady interest rates coming into the next quarter of 2025. So this week we are enjoying 4.19% on the 10-year, down 3 basis points. We're going to see on both the 10-year and the mortgage-backed security markets, we're kind of hitting a low point in rates, a high point in price when it comes to the security of the bonds being sold to investors. So let's take a look. So as we look back to last year at 4.19% on the 10-year, we can see that was pretty close to the low point back in December when we had a little bit of relief in November, early December. And prior to that, we had remained below that up until around October the 21st. So for the back part of the summer, so from July, a lot of the newsworthiness in July of last year was that the Fed was going to start cutting the interest rates. They didn't cut it in July, but it was likely they were going to cut it in September, which they did. So you can see that the run-up to the excitement around the Fed's cutting interest rates actually brought the 10-year Treasury down in anticipation. And then shortly after, we saw the move higher. It paused and then came back higher again before we peaked back on January 14th. And we can see from the 3-month chart that, of course, as far as 2025 goes, we are at the low point, and we're just below the 200-day average, just hanging on to it as of this morning, with the next major piece of news coming this Friday with the unemployment report for February, which will come out on Friday morning pre-market. Now, sometimes we go over the mortgage-backed security prices. This actually works in the reverse. As the price actually goes higher on a mortgage-backed security price to the investor, the net interest rate to the consumer is going to go down. And as you can see in the reverse from the 10-year Treasury, we see we're at a high point. We're actually quite a bit above the 200-day average, so good run-up in mortgage-backed security prices. This has really been a benefit, dropping mortgage rates about 0.25% in the last 2 weeks, just under 7% from a few weeks ago, down to 6.7 to 6.6% on the 30-year mortgage. So we have seen kind of a topping off here. I think this week, both the 10-year and the mortgage bonds are going to wait to see what happens in the news with the unemployment report, like I said, being the next big major piece of data to hit the market. So as we keep an eye on the future direction of interest rates, just keep in mind that they will ebb and flow, but likely we've seen the high point, at least for the short term, in interest rates, barring any major negative news. If inflation continued to be around that 2.5% mark, that will keep the Federal Reserve at bay. They shouldn't be raising their short-term interest rate. They shouldn't be lowering their short-term interest rate. But we will see on the 10-year, the longer-term bonds, if that can start to react to upcoming new administration news that they are actually, the Trump administration specifically, Scott Bessent, the Treasury Secretary, is going to not seek to put any more treasuries on the market. So they're going to continue to issue treasuries each month. That's how the government funds their operations. They're going to lean towards shorter term bonds in order to do that, which should rob the market of as much supply in the 10-year and longer term treasury bonds, which could hold down interest rates, at least in the long term. So we'll see. I think that could take a good 6 months to play out. So as we get into the spring season here, as far as the selling season, March being upon us, that could be a benefit to at least steadier interest rates to get buyers and sellers off the fence and out into the marketplace as we hopefully get some good weather ahead. Have a great one.